Welcome to the Market Eye podcast from Generating Alpha. Our mission is to cut through all that relentless market noise so that you, the retail investor, can get the essential news quickly and really focus on the signals that matter. Today, we're looking at what feels like a capital crossroads, seeing how the pressure of these high interest rates is, hitting corporate plans and consumer strength all over the world. But before we jump into all that, we have our mandatory disclaimer. This podcast is for entertainment and education purposes only, and in no way does it constitute individual investment advice. It is curated by humans, presented by AI, and proudly sponsored by The Compounding Machine, thecompoundingmachine.substack.com. Okay, let's start with the big picture. The past week really showed how different parts of the world are going in different directions, but the one thing they all had in common was this anxiety over high interest rates. So what were the major moves we saw?
Right. The U.S. markets, I think, gave the clearest signal of this. Stocks finished mixed, but the real story was a rotation out of those high-flying stocks.
So people moving away from growth and AI.
Exactly. While the Dow and the S&P 500 did okay, they saw modest gains. The tech-heavy NASDAQ and, more importantly, the small-cap Russell 2000 lost ground. The feeling is that valuations are just, running way too hot for this kind of interest rate environment.
And we did see some political good news, right? The longest government shutdown on record finally ended on Wednesday.
A small relief, yeah.
Yeah.
But it didn't seem to thaw the Federal Reserve's stance at all.
Still hawkish.
Oh, absolutely. It didn't override their focus. We heard consistently cautious commentary from multiple policymakers, Bostic, Musalem, Hammack. All of them were stressing the need to keep rates restrictive to fight inflation.
And that hit market expectations immediately.
Instantly. I mean, just 1 month ago, a December rate cut had, a 95% probability priced in?
And what is it now?
It's plummeted. It's down to about 46%. And that repricing, that's what explains the pain we saw in the small cap stocks.
The Russell 2000.
Yep. It underperformed big time, dropping 1.83%. Smaller companies, they just get punished much faster by high rates than the blue chips do.
And this wasn't just a U.S. story. Looking over at Europe, it seemed like they got a bit of a relief rally, but the underlying pressures are similar.
Indeed. The pan-European STOXX 600, which is a good barometer for the whole continent's biggest stocks, it gained 1.77%. But when you look under the surface, the data is, it's worrying.
What are we seeing?
The UK labor market data was disappointing. Unemployment ticked up to 5%, wage growth slowed down. Even their Q3 GDP growth was just, really tepid at 0.1%.
So with weak labor and weak growth, the conversation there is probably more about potential rate cuts than hikes. What about the core of the Eurozone?
Well, weaker industrial output than expected. It only ticked up 0.2% when the forecast was for 0.9. And what's maybe more concerning is that investor sentiment in Germany, the economic engine, it fell unexpectedly.
A lack of confidence in the recovery.
It really points to growing doubts that the economic recovery can hold up with sticky inflation and strained consumers.
Okay, let's pivot over to Asia. Japan looked a bit stronger on the surface. The Nikkei and the Topix both gained.
They did, but the yen is still under a lot of pressure. It weakened quite a bit to 154.6 against the U.S. dollar.
And what's driving that?
A lot of it is tied to expectations around the new prime minister, Sanae Takaichi. She's seen as favoring pretty aggressive fiscal spending.
So more government spending, plus the idea that the Bank of Japan will wait a bit longer to raise rates.
Exactly. So the market is now pushing its expectation for a Bank of Japan rate hike out to January instead of December. But on a positive note, manufacturer confidence is rising. That points to some real underlying strength.
And to round out the global picture, China. The economic signals coming out of the mainland markets, they retreated, right? The CSI 300 was down.
Yeah, and the data there really points to some deep structural strain. Industrial production and retail sales for October were both weaker than expected.
But what was the biggest red flag?
I think the most significant piece of data was fixed asset investment. It actually shrank 1.7% in the first 10 months of the year. That's a record drop for that period. It just highlights the strain on, local governments and issues with where capital's going.
And the housing market is still struggling.
Oh, absolutely.
Yeah.
New home prices saw their steepest decline in a year. The central government did approve a trillion RMB in stimulus, but the market is pretty skeptical that he can turn things around quickly.
Okay, so let's move from those macro currents down to some specific companies. Starting in the U.S. with Disney, this one was fascinating. They beat on adjusted earnings per share, hitting $1.11 versus the 105
Oh,
estimate.
yeah.
But revenue missed slightly, and the stock just got crushed, dropping over 8% pre-market. So why did the market punish them so hard?
That's the classic paradox of a big transformation story, isn't it? Investors are looking right past the current profitability, and they're focused entirely on the growth trajectory. That slight revenue miss, 22.5 billion versus a 22.75 billion consensus, it just hints at a slowdown.
And for a company in the middle of a huge, expensive pivot to streaming, any slowdown is a big deal.
It gets magnified. Exactly. Any hint of slower customer acquisition is a major red flag for the market right now.
But management sounded so confident. They're forecasting double-digit EPS growth for fiscal 26. They doubled their share buybacks to $7 billion, and they jacked up the dividend by 50%.
And those are all really strong signals. It shows that management believes the underlying business, especially the direct-to-consumer streaming segment, is on the right track. I mean, its operating income was up 39%.
And that ESPN bundle seems to be a hit.
A huge hit. 80% of people chose it, which shows their cross-selling is working. But, in today's environment, the market is just absolutely ruthless about top-line growth.
Okay, let's stick with growth, but shift to AI infrastructure. Coreweave. They're a private company, but their results are a really important early signal for the whole AI space, right? It impacts NVIDIA, the big cloud providers.
That's a vital indicator.
Oh, well.
And the demand is just, it's explosive. The revenue surged 134% year over year.
They did report a loss per share, though.
They did, but it was a much smaller loss than expected. The real focus for the market, though, was on the guidance. The stock actually slipped pre-market because they lowered their full-year revenue forecast just a little bit.
And what was the cause? Was it a demand problem? Because that would be a huge deal for the AI story.
No, and this is the crucial point. It was not a demand problem. The guidance cut was driven entirely by a fixable supply constraint.
So a bottleneck.
Exactly. A temporary delay at one of their third-party data center partners. The analyst notes were all very clear. Demand is still incredibly strong, and Coreweave is betting on it. They're planning to spend $12 to $14 billion on capital expenditures for 2026.
Wow, that's a massive bet on infrastructure.
It confirms the AI compute race is just accelerating. It's not slowing down at all.
Which brings us back to our theme, right? High ambition meeting high capital costs. Let's jump back across the pond to the UK and look at Rolls-Royce. They reaffirmed their guidance for 2025.
Right. Rolls-Royce is a great example of a multi-year industrial recovery story. They stuck firmly to their targets, operating profit of around 3.1 to 3.2 billion pounds and free cash flow in the same ballpark.
And the civil aerospace division is really driving that. We saw engine flying hours actually surpass pre-pandemic levels.
They hit 109% of 2019 levels. That is a huge indicator of how much global air travel has recovered. But strategically, you have to look at their future growth areas.
You mean beyond jet engines?
Way beyond. Yeah. They're making really serious progress in power systems, especially for data centers and in defense. And of course, their work on small modular reactors, or SMRs.
SMRs are that critical long-term play on clean, stable energy.
Exactly. And Rolls-Royce SMR has advanced to the final stage in Sweden's selection process. They're a preferred provider in the UK. They are positioning themselves right at the heart of the global energy transition. It's a huge decade-long bet on essential infrastructure.
Now let's look at another UK name, 3i Group. It's a listed private equity firm. They reported H1 results that were technically in line. Solid return, net asset value went up, and yet the shares fell more than 10%.
A classic market paradox, isn't it?
So what happened? Why the steep drop if they met expectations?
The market reaction was all about the health of their main asset, which is the discount retailer, Action. The H1 results were fine, but more recent trading in Action showed some signs of softening.
Interesting. How?
Well, their like-for-like growth eased to 5.7%. Now, that was partly due to tough comparisons to last year, but also some seasonal softness and, importantly, weaker trading in France.
So even if the parent company results were on target, a potential headwind in their biggest investment was enough to cause a sell-off.
That's it. And it tells you something really important about the broader consumer landscape.
What's the signal there?
It's a signal that consumer resilience in Europe might be cracking. I mean, if people are trading down to discount retailers like Action, and then those retailers start to show weakness, It suggests consumers are under some pretty severe financial pressure. That could challenge the whole consensus view on Europe heading into the holidays.
Okay, let's look forward then. What does the calendar for the week of November 17th through the 21st tell us? It seems to be all about inflation and manufacturing data.
Pretty much. The first big test is on Monday, November 17th. We get the U.S. NY Empire State Manufacturing Index. It's an early look at factory health.
Then on Tuesday, the 18th, we get U.S. industrial production and the NAHB Housing Market Index. Manufacturing and housing, both very sensitive to interest rates.
Then Wednesday, November 19th is a huge inflation day globally. We get the UK inflation rate and the Euro area CPI final. But for the U.S., the big one is the release of the FOMC minutes.
Right. Those are the detailed notes from the Fed's last meeting. That'll give us a much clearer picture of why they're being so cautious and so reluctant to signal any rate cuts.
Exactly. Then Thursday, attention is back on the U.S. labor market with the jobless claims reports, plus another manufacturing index from the Philadelphia Fed.
And we close out the week on Friday the 21st with a global data dump.
A big one. The critical S&P Global PMI flash numbers.
And PMI is the Purchasing Managers Index.
Right. And these surveys for manufacturing and services across the U.S., Europe, the U.K., and Japan, they give us a real-time, forward-looking snapshot of what's happening. They'll either confirm or challenge this slowing growth narrative we've been talking about.
So a lot to watch. Here's a final strategic thought for you to chew on. We saw Coreweave planning this massive multi-billion-dollar AI cloud expansion and Rolls-Royce doubling down on small modular reactors for nuclear power. Both are making these huge multi-decade infrastructure bets that need immense capital. Which long-term infrastructure bet nuclear power systems or AI cloud compute do you think faces the tougher scaling challenge over the next 5 years? Thank you for tuning in to the latest deep dive on the Mark and I podcast from Generating Alpha. And remember to check out our sponsor, The Compounding Machine, which you can find at thecompoundingmachine.substack.com. Goodbye.